Okay, good afternoon, everyone. Thanks for attending our quarterly market performance property market update. Our presenter today will be our director, David McMillan. Any questions, please just type them into the chat box. Monitoring the chat box for questions, and David or someone else can answer them at the end. But otherwise, over to you, David, and yeah, thanks for putting this together.
Thanks, Paul. Most people on the call today are very familiar with our business, so I'm not going to go into too much who we are, but I will remind everyone that today the information provided is general in nature, and if you want some specific property advice, please reach out to your advisor. The first slide I want to touch on, I enjoyed touching on this slide primarily because when COVID hit, the media had the market coming off anywhere from 20 to 40%. And this is what has transpired. So obviously almost the direct opposite. And the reminder here is just whatever you're reading in the papers is probably not how the market is going to play out. And in order to understand how the market is going to play out, this is why we do these sessions, to educate our client base and our referral partners. When we look at the biggest theme going on, there's two massive themes. One is interest rates and the other one is the supply situation across the country. We have been talking about the supply problem for a couple of years, and now it's starting to get a lot more attention in mainstream media. And the problem is real, and the problem is going to get worse. As we can see, this is vacancy rates in all the capital cities across the country. They've been trending down since 2018. Most vacancy rates are sub 1% now, and rents are rising across the country. Our view is that rents will rise double-digit growth for at least 3 years, because even if they had a solution to the supply problem, which they don't, it would take 3 years to fix. So expect rising rents for the next for about 3 to 4 years. And expect rents to be rising aggressively. The problem isn't just in capital cities, it's also in regional towns. This is the major regional towns around the country, and as you can see, vacancy rates have been trending down since 2018. So it's not just rental growth in the capital cities, it's also rental growth in all the major regional markets as well. We simply aren't building enough. This is dwelling approvals over the last sort of almost 10 years now. As you can see, every year we've been building slightly less and the trend is down, and that's why the undersupply has occurred. But importantly, the undersupply has occurred with 2 years of almost zero overseas migration. So the green bars here are our overseas migration figures, and this is back to the year 2000. The blue bars is natural population growth, new births, and usually we get 200,000 overseas migrants if our unemployment rate is low enough. Migrants obviously follow the work. You can see that over the past almost 15 years, we've almost got 200,000 every year. In 2020 and 2021, sorry, I can't actually see those numbers. Yeah, in 2020 and 2021, we got zero overseas migrants. In fact, we lost migrants to overseas, which that's the first time that's happened as far back as we can get the data. So the undersupply has occurred, even though we haven't been getting our overseas migrants. Now we've seen migration rush back to Australia. They've obviously filled up whatever vacancies there were, and now we're seeing incredible pressure on rents Australia-wide. Obviously a good thing if you're an investor, and it's creating a big headache for the government, because those people that are marginalised, we're running out of space and there'll be nowhere for them to live, and that's going to create a social problem. With respect to the other theme that I mentioned, the other theme, quite obvious, is the cash rate rising. The cash rate's been rising, I think, now for almost 18 months. It's been the most aggressive rise of the percentage that we've ever seen. It's in relation to trying to curb inflation. The inflation trend started to go the right way about 3 or 4 months ago. It's tracking down, but not the trend isn't aggressive enough, and the RBA have obviously increased rates as recent as last week. So we've got a cash rate that is making it very hard for those taking on mortgages to service their debts, and it's reducing borrowing capacities, and it's having a definite effect on the market. With respect to inflation and the cash rate, this is inflation and the cash rate back to 1990. Usually, in order for inflation to be under control, the cash rate is higher than inflation. So you can imagine what that might mean. Internally, we think that the cash rate will settle at about 2.85% somewhere in the next 24 months, but it looks like it's going to be a wild ride until we get there. There's economists predicting 2 or 3 more rate rises because of the new information that's come to hand in the last sort of 30, 60 days. So for property investors, we need to make sure that we have adequate cash buffers to deal with the rising cost of interest. And if your cash buffer isn't where you think it needs to be, the next step is just to chat to an advisor to see what options you've got available. Potentially selling an asset, potentially refinancing. You know, there's a range of different things that we can walk through. Let's talk about Sydney now. So Sydney is an important market because Sydney leads the national market, and when Sydney sets a new price, it sets a high watermark for the country. Now, the Sydney market peaked in 2020, 2021 at a median price of 1.475. And obviously on a rising cash rate, people's borrowing capacities came off, people's desire to buy property was subdued. And so what we saw was the median price of Sydney drop from 1.475 at the peak down to around 1.25 where it is now. The significance of that is no capital city or regional town ever goes past Sydney at a median price level. So what we're trying to communicate is that expect this to set the high watermark for the country. Probably 1.2 million is probably where all markets will settle below in this property cycle. And Sydney has some serious challenges, the most obvious of which is its affordability. This is the affordability index in Sydney back to 1980. And what this measures is the percentage of the average wage that goes to the average mortgage repayment, principal and interest loan, assuming a 20% deposit and the current variable rate. Sydney, hopefully it might be hard to see or it could just be on my screen, but Sydney never gets past an affordability index of 60, I should say. And that means that when 60% of the average wage goes to the average mortgage repayment, the market typically falls. The green line down here is the percentage growth year on year in the market. And what you can see when the affordability index gets to 60%, the market in either the following year or the year after comes off. We saw that in 1980. We saw that in 2004. We saw the market come off. We saw that in 2008. We saw the market come off. 2010, we saw the market come off. 2017, we saw the market come off. The scary thing with Sydney at the moment is the affordability index isn't at 60. It's in the 70s. And the rate rise that happened during last week hasn't been reflected in these numbers yet. It hasn't made our way into our models. So we're probably talking about an affordability index of 75%, meaning that 75% of the average wage in Sydney is consumed for the average new mortgage. So these are pretty scary figures. And that's why when we learned that the Sydney median price had gone up in the last few months, it was very unusual. We have a base case that Sydney on current rates must fall around 10%. So Sydney does have serious challenges with regards to people being able to service debts on new mortgages. That's why we think the market's going to fall. Furthermore, we also think there's going to be some pretty significant mortgage stress in Sydney, which will probably result in some distressed selling. And we've seen some evidence of that at the moment, anecdotally, but only on a very small scale. The other thing that's an issue in terms of affordability for Sydney is it is now the most difficult market to save a deposit in. The average house price in Sydney is 14 times the average income. If you're a new entrant to the market trying to save a deposit for a home, it's incredibly difficult. We've also done a worldwide study to have a look at price to income ratios around the world, and no capital city ever gets past 14 times a price to income ratio without allowing foreign capital into its established real estate market. And Australia doesn't allow foreign capital into its established real estate market. So Sydney pushed to 14 times last year, and then obviously what's happened is it's come off. So that's a fairly interesting story, again, because Sydney sets the high watermark for the country, and we think that Sydney median price is somewhat going to settle this cycle somewhere between 1.1 and 1.2.5, somewhere in that range. The other thing that's opened up is, while Sydney house prices have gone on a run, Sydney units have basically flatlined over the last 7 or 8 years. You can see that the price to income ratio on Sydney units has come off, and the price to income ratio on Sydney houses is very high. So we're beginning to identify an opportunity perhaps that's brewing for Sydney units coming into 2024, and we'll touch on that in a little bit. As I mentioned earlier, the macro theme is there's not enough supply. There's not enough supply everywhere. Sydney shows a vacancy rate at the moment of 1.4, and we've seen rental growth from 600 on houses up to 950. So significant rental increases in Sydney, up to 50%, clearly telling us that the market's undersupplied. So while Sydney prices are very high, the market doesn't look like it's going to drop off a cliff because there's not enough bedrooms to go around, and therefore it's going to be robust, although be it that we definitely think it's going to soften. Sydney stock is remaining fairly flat. It's been fairly flat for the last few years. But in terms of migration flows, in terms of that undersupply, we think that's going to persist because the jobs growth numbers in Sydney are very strong. So the summary there is Sydney should soften in the housing market. Rents should continue to rise. Units are showing value, and the high watermark for the country this cycle has been set by Sydney somewhere between 1.1 and 1.2.5. If there's questions on Sydney, we can come back at the end. I think Paul's going to moderate a Q&A session. In terms of Melbourne, so Melbourne median house price 870. Melbourne as well, from an affordability index, is showing about 50, in the mid 50s, somewhere around that 55% at the moment. Melbourne typically stops growing at around 55%. So we're basically at the high watermark that Melbourne sets in terms of debt service. What that tells us is there's not any real predictable growth as far as we can tell from an affordability standpoint in Melbourne. Rates would need to come off in order for a value opportunity to appear, or prices would need to come off, or incomes would need to rise, or a combination of those things happening would lead for us to identify a value play in Melbourne. Stocks are relatively consistent, days on market relatively consistent. So the market in Melbourne isn't really telling us anything other than it's expensive at the moment. In terms of rents are up, but they're up from 528 to 672. So by comparison to Sydney rents up 50%, Melbourne rents up 20%. We've got a lower vacancy rate than Sydney at 1.2, Sydney's 1.4, but you can clearly see that might be inaccurate because rents in Sydney are up 50% versus Melbourne up 20. So Melbourne isn't experiencing the same chronic shortage as Sydney. Melbourne is more affordable than Sydney, but it's by its long-term standards, it's getting up to its affordability thresholds. Brisbane. So Brisbane median house price of 755. As most of you know, if you're clients, we had a massive position in Brisbane. A lot of our clients up there have done very well. We bought about 800 homes there. We got into Brisbane in this period here, just before it ticked up. Our view of Brisbane is it's probably past mid-cycle. It does have some growth left. Affordability is still there, even in this high interest rate environment. When I say it's still there, it's still showing some capacity to move. The runway that we have on Brisbane at the moment, depending on where you see the cash rate selling, is somewhere between that 20 and 40%, and that also depends on the pocket of Brisbane that you're buying into. We don't have a value play in Brisbane anymore. It's more of a mid-cycle play. Some clients are entering into Brisbane from an asset diversification point of view, but it's not where we're focusing most of our energy at the moment. Brisbane units are still showing extreme value. This is the house price in Brisbane versus the unit price in Brisbane. As you can see, unit prices in Brisbane have been flat since 2007, only marginally up, showing extreme value by comparison to houses, and are now experiencing very strong rental growth and single-digit price growth, even in the face of a softening unit market. So that is interesting to observe. Stock in Brisbane is low. Days on market in Brisbane is low. It's on a 5-year downward trend. So we're expecting the Brisbane market, even though it's softened in the last 12 months because of a rising cash rate, to be fairly robust. Southeast Queensland has a very low vacancy rate in general. We're anticipating rental growth. We're anticipating growth in units, and we're anticipating modest growth in housing. As you can see here, vacancy rate of 1%. Rents up from 470 to 670, so just short of a 50% increase in unit rentals, which tells us that undersupply up there is real and rents are responding accordingly. Sorry if you can hear some dogs in the background. We're minding a third animal today. With respect to Perth, this is an area where we're directing most of our capital at the moment. For obvious reasons, it is in the value stage of the cycle, or we believe it to be in the value stage of the cycle. The market has been in a relative correction since 2009. Since 2009, prices are up just over 10%. So that's a huge stagnation, 12, 13-year stagnation. We'd like Perth because it is very easy to save a deposit. The average house price is 5.5 times the average income versus Sydney, which, if you recall, was 14 times. So it's an affordable market for a first home buyer. In terms of a debt service repayment, only 30% of the average wage is consumed by the average mortgage repayment versus Sydney, which is 75. So it is affordable to service your mortgage. It's affordable to save a deposit. It's also affordable for investors to come into at a mid sort of $600,000-$800,000 price point. Stock is falling every month at the moment. We see here that there's 18,300 properties for sale, but in reality, there's a lot of listings left on realestate.com that are actually under contract. There's more listings left on realestate.com under contract in WA as a percentage than anywhere else. Once you go houses, Perth, and then you exclude properties that are under contract, there's around 4,500 houses for sale in WA. So there's extreme pressure on the existing stock that's for sale, and that's being reflected in the lowest days on market properties rolling over in Perth every 16 days, which is almost the hottest in the country at the moment. With respect to rents are up a good 50% over the last 3 years, and the vacancy rate is sub 1%. So the summary with Perth is that we are directing a lot of attention there. We're buying a property in Perth, more than one property in Perth every day. Our rental department over there is seeing massive growth in rents. We're achieving the rents that we're setting. In some cases, we're exceeding the rents that we're setting in the investment report. We can still buy into that market for as low as $500K, and most of our investment is going into Perth between $500,000 and $1 million. The strategy in Perth, as some of you will probably be aware, is not to buy and hold. And the reason why we don't buy and hold long term is primarily because of these very long corrections and these very aggressive growth periods. So once a very aggressive growth period has occurred and the market is very expensive, we will then typically sell the property, pay the capital gains tax, and of course the capital gains tax, even if you're on a 47% tax rate, is about 23.5% tax because of the CGT free portion. So we take those gains and then we will pay off debt either on the principal place of residence or elsewhere in the portfolio. In terms of the national markets, So it's probably the hardest time to be forecasting the market at the moment that I've experienced in 10 years. Our business is meeting all the time to discuss the cash rate, the investment committee, the research committee. When you have a cash rate moving as quickly as it has, it makes it incredibly difficult to forecast, because 70% of the reason why prices move is because of the influence of interest rates. So it does make it a particularly challenging time for us at the moment. We definitely see Sydney and New South Wales regional markets in correction. We see Melbourne sort of approaching the top, although we're reviewing the way that we look at Melbourne, because Melbourne doesn't have classic cycles like the other markets have cycles. So we're looking at Melbourne and trying to analyze different ways that we can approach reviewing the market, because historically we've missed value pockets in Melbourne, which has been something that we've been really frustrated with. So we're reviewing the way that we do our research, specifically in reference to Melbourne, because it doesn't have classic cycles. As we discussed, Brisbane still has more growth in it, somewhere between 20 to 40% on our cash rate assumption, which is 2.85 within the next 24 months. We've obviously bought an incredible amount of property in Adelaide. Adelaide has a little bit less runway than Brisbane to go, somewhere around that 20 to 30%, again, depending on where the cash rate settles. But the markets that we genuinely like at the moment, Perth, obviously, for the reasons that we've just outlined. We like Rockhampton in Queensland. We think that's got at least 50% growth coming. We like Rockingham, south of Perth. We think that's got somewhere in the order of what Perth has got, which is about 50 to 100% coming. And from a residential standpoint, they're our major focuses at the moment. With respect to units, most of you know that we don't buy units. The reason why we don't buy units is because we can get oversupplied very quickly, and that can cause problems for our long-term compounding rates. There is one unit market that we have bought historically that has done very well for clients, which is Sydney unit markets, the Sydney unit market, and that's because Sydney is completely capped in terms of its supply, and units in those blue chip suburbs behave like houses from a long-term growth perspective. As I mentioned earlier, when we look at Sydney units, they have been stagnating for the last 6 to 7 years. Rents have increased quite dramatically over that period of time, and yields are moving to a point where they were back in 2012. And in 2012, shortly thereafter, the market doubled between 2012 and 2017. So we are investigating Sydney units as a possible opportunity, a value opportunity for our client base. It's currently under review with the investment committee. These things take time to approve for obvious reasons. Once we approve a market, we typically put in hundreds of millions of dollars of investment. And as you can see, it's a little bit of a lone ranger sitting in the downturn phase, which we may be pushing that into the value stage within the next sort of 6 months. In terms of probabilities, hopefully you can see this is a fairly important slide. The research committee is assuming how much growth there is in different markets, assuming different cash rates. Because as I mentioned earlier, the reason why markets, 70% of the reasons why markets go up, down, or sideways is because of where the cash rate is positioned. It's not the whole story, but it's certainly a large chunk of the story. I'm not going to go into this in any great detail other than to say at a cash rate of 3.85, we still have Perth with a runway of 84%. With respect to Rockingham, we still have a cash rate, we still have a runway of 70% on a cash rate of 3.85. And these are the most important markets for us, because even if interest rates continue to go up, which they might in the short term, the very short term, these markets still have an incredible amount of runway in them. And on a softening cash rate, which is probably going to be the theme for 2024, rates may get a little bit higher. The RBA will finally get the inflation trend where they want it. They may create a lot of carnage by continuing to push the cash rate. But 2024, there's almost unanimous agreement across economists that it's going to be characterized by a softening cash rate. So what matters most is not where the cash rate is going to go and be there temporarily. What matters most is where the cash rate is going to settle in the medium term, and that's kind of what we're trying to do when we're forecasting markets is understand where the cash rate is going to settle. So we're always going to be wrong, but what we've tried to do every year is get better and better at a research committee level and an investment committee level, so we can be less wrong. Commercial is now a big part of our business. Obviously, the first 5 years of our business was mostly almost 100% residential, but over the next 5 years, we've sort of been increasing our commercial capacity. We're buying commercial now, 2 or 3 commercial properties or more every month. They are very, very difficult to find at the moment, primarily because transaction volumes are down considerably. So in the 2022 calendar year, commercial returns were pretty good, 6.8% total return, but transaction volumes were down 66%. So very difficult to find the sort of stock that what we're after for clients. Historically, there's a 6-month lag from transaction volumes to that following into prices. We really haven't seen prices soften in the commercial market yet, even though in theory they should be softening. We're seeing cash rates go from, 4.5 to 5 or 5 to 5.5, which is a 50 basis point, softening in the cash rate. But we've had not the cash rate, the yield, but we've had the cash rate increase 400 basis points. So it's a funny market to be operating in. We're of the view that it should be softening a bit more aggressive than it is, but it's currently not. One of the arguments for the market not to be softening is because there hasn't been a lot of construction, and because there isn't a lot of construction coming through the pipeline, that's keeping rents really robust, and in a lot of markets keeping rental growth rising aggressively, just like in the residential market. It was that COVID period where not much was built, and post-COVID not much has been built because there's been this real uncertainty around construction costs. So that's pushing up rents in the residential market, but it's also pushing up rents in the commercial market. And it's one of the reasons why we're not seeing commercial values come off or yields soften aggressively, because everything that's quality is basically tenanted and rents are going up when there's a review. Quality defensive commercial property is yielding between, this is net, 4.5 to 5.5 right now as we speak. The commercial department and the acquisitions as part of our clients' strategies, we're trying to buy on yields higher than that with quality defensive tenants. It has been an incredible challenge. We would analyze basically everything that comes on the market in the commercial nationally in the commercial sector, and we would analyze hundreds of properties off market every month, and we're buying 2 or 3 properties. That's how difficult it is. We're going very slowly because with commercial property, when we buy it for clients, the strategy typically is to never sell it. Therefore, it needs to be very high quality, and it needs to be something that we can stamp our reputation on when we look back 5 years from today and say, we're glad we bought that for a client, even in a really challenging market. So even though we think that the commercial yields should soften a little bit, we also think rents will tick up a little bit, and we think the commercial market could soften, but also has the capacity to be very robust and maybe go sideways. In that regard, commercial property is an income play. It's all about starting yield, quality building, quality of tenant. We are still finding opportunities for our private clients north of that 2 mil mark, and obviously we're buying properties as part of our funds management business, albeit we have to be very selective, and at the moment we're doing very low volumes. In terms of our recommended commercial strategies, principal place of business, a lot of these are done through a SMSF. If you are a business owner and you have the ability to buy a principal place of business and you have a very long-term strategy, depending on where and what it is, a lot of those strategies do make sense. We are buying passive, defensive, income-producing assets. So when we say passive, it means that we don't do anything. We're not doing development. When we say defensive, it means that we're renting to AAA tenancies, AA tenancies, or A-grade tenancies, and they are tenancies that are either the government themselves, government-backed tenancies, or non-discretionary spending tenancies. So anyone that's thinking about commercial property, we can sort of walk you through that. We're trying to get those yields on the lease terms that we like at north of a 5.5% net yield. We do like medium-term development sites with commercial net income, and the reason why we like medium to long-term development sites is apartments should grow very aggressively over the medium term because of the undersupply. We're also creating a number of strategic partnerships where we will identify buildings for tenants that want to expand, and those tenants need to fit the category of AA, AAA, and A grade tenancies, and then we will, we'll buy the property with the tenant in mind, put the deal together, and then allocate it to a client or allocate it to the fund. It's going to become a larger and larger part of our business into the next decade. So the summary, and hopefully I'm keeping time here, Paul. The summary is rising interest rates will produce headwinds across the country to all markets. That's not just commercial property, residential property, but to every single market, equities, crypto, etc. All markets are going to be hurt by rising interest rates. Residential and commercial markets are heavily undersupplied at the moment because there's been this real lull in construction over COVID, and because construction costs are really expensive post-COVID. So the rental crisis is set to get worse. This is a positive for existing landlords because your rent should go up, and because our interest is going up, we really need to get our rents up. So in my meetings with clients, we've really been encouraging to challenge the property managers to get as much rental growth as we can. It is still a good opportunity, and I want to reiterate, even in this high cash rate environment, it is still a good opportunity to acquire residential growth assets in our approved markets. So that's Rockhampton, Rockingham, and Perth. Those markets we still see considerable growth in. Those markets are still rising at the moment, and those markets should have aggressive price growth once the cash rate begins to soften in 2024. With clients that have properties in, Brisbane and Adelaide and other markets that we've recommended, Bendigo, Ballarat, over the years, we still see growth in those markets. Not enough growth to enter those markets en masse, but we still see good growth in those markets. So the advice is still to hold. And the next 2 to 4 years should be strong growth years on a falling cash rate and rising rents. So we see rising rents, we see a falling cash rate, we see a housing shortage. So therefore we see growth. And there'll probably be a national peak in residential property somewhere around that 2026. And the purpose of having annual meetings with your advisor is to make sure that we get those selling windows right for those clients that are selling. Importantly, those clients that are moving into less than 10 years from retirement, which we've got many clients moving into this phase as we're all getting older, we're now starting to have a strong focus on increasing, that should be increasing, typo from me, increasing net yield within the portfolio. So residential property will show a net yield of 1.5 to 2 net. It's actually not enough to retire on for most people. And therefore, we really need to get net yields up, especially in that last phase into retirement. We're having those conversations in our annual meetings. That involves, if you're going to stay in property, commercial property, in either a direct ownership setting or into our commercial property funds management business, either in a syndicated property or a commercial fund. And you'll notice a real pivot in our language in the annual meetings around these products, because these products are becoming very relevant for those clients that want to start to look at income within their portfolios. So that's also going to become a major theme. In terms of recent acquisitions, just to roll through, so this is something that we bought in Rockhampton. The growth in Rockhampton we anticipate is somewhere north of 50%. Hard to quantify in this really funny cash rate environment at the moment. This is what we're buying in Rockingham and our south of Perth. Forecasted growth somewhere between 50 and 100%. For those of you who have been with our business for some time, we just buy established quality housing. So aesthetically, you would want something more beautiful, but this is what we believe is going to work. When we're in, this is Bayswater, a suburb of Perth. This is another example of a property that we've bought in a AAA suburb, A-grade home. Here's a good example of a commercial property that we've bought. This was a police command centre in WA. I think the lease was, a 5 by 5 year lease. and it is basically we're leasing to the government. We have strong increases within the annual lease terms. This was a purpose-built facility for them. Hopefully they never move, and we hold this property forever, 20, 30 years. That's the sort of stuff we're buying. But as you can see, it comes at a certain price point that can be prohibitive for some investors, depending on household income. This is a commercial property that we bought in Albion. It showed a passing net income of 4%, but it's actually a development site, and we can go up to 5 levels. We think Brisbane Apartments are going to go very aggressive in the next 5 years, and then this site will become very valuable, and therefore this client will do very well. We're anticipating somewhere in the order of 50% growth in a short period of time. This is a logistical warehouse in Brisbane, Crestmead, net yield of 6.26 for a client. The property was under rented, so once we go through a rental review, the net yield will be about 7%. And this is the sort of stuff that we're putting in larger clients' portfolios. In terms of clients that can't access commercial property directly, some clients won't be able to spend $2 million or $4 million on their own property. We have obviously our funds business, and again, this is just general information. It's not specific advice, but our income funds have been set up to provide income for clients within property as they move towards retirement. So it's only available to sophisticated and wholesale investors. And if you're interested in coming into these funds, I would encourage you to reach out to your advisor for a one-on-one. We're finishing a raise at the moment on something that's showing a net 8% return. We've got about 400,000 left of a $4 million fund, and we will be talking about more about these products as the years unfold. I think I've gone my full time, Paul, so perhaps we'll open up for questions if there are any.
Thanks, David. No questions in the chat, but does anyone have any questions at all before we finish up? All right, James, thank you, David. Why is it that Sydney units are better priced or better placed from 2024, and is this only for a certain price range?
That's a good question. Where the investment committee is reviewing Sydney units now, what's clear to us is there's been a stagnation over the last 7 years, so that's a tick. We've seen rising gross yields, so that's another tick. And we're investigating if there is an actual opportunity, and if there is, will probably contain our acquisition strategy to the very blue chip markets in the low density space. Does that answer the question, Paul?
Price range. Yeah, the price range. So why is it only for a certain? Is it only for a certain price range?
Well, in terms of the price range, is one, it needs to be accessible for investors. So investors need to be able to afford it, and usually our investors are spending less than 1.2 on a property. So that's the first thing. It needs to be accessible, and then it needs to make sense in the context of how big the property portfolio is. So I think when we go to Sydney, the unit dollar price that we'll be looking at is somewhere between 700 and 1.2.
Yep. Okay. Thank you. Yep. Thank you, David. From James. Any other questions while we're all together? Of course, anyone here can always reach out to your advisor for specific information. Obviously, we're doing our portfolio reviews with all our clients as well. So feel free to reach out to your advisor, and we might wrap it up there. So thanks again, David. Thanks everyone for your time, and we'll see you next quarter. All right. Goodbye.
Thanks, Paul.